Welcome back to the deep dive. So today we're going to do something a little different. I want you to picture your investment app for a second.
Okay.
You see a mutual fund. Let's call it the Blue Chip Growth Fund. And you tap that big green invest button. What do you think just happened?
Most people would think, I just sent my money to a company.
Exactly. Like buying something on Amazon. You pay the company, they give you the service. Simple.
Right, and that's the intuitive way to see it. But if you think a mutual fund is just a regular company like Netflix, you're missing the most important safety feature of your entire portfolio.
And that is what this deep dive is all about. We're tearing apart the legal structure of mutual funds in India, pulling directly from Chapter 3 of the NISM series VA workbook.
And I know legal structure sounds, incredibly dry.
It does.
But this isn't about jargon. It's really a masterclass in how to build a financial fortress. It's the reason why, when you hear about scams, you almost never hear about a mutual fund manager just running away with the money.
You mean the money can go down because the market tanks? That's market risk.
That's market risk. But the money disappearing because the founder decided to buy a yacht, that's fraud. And this structure is engineered to make that fraud, well, nearly impossible.
Nearly impossible. That is a bold claim. So let's put it to the test. If I'm not giving my money to a company, what am I giving it to?
You're contributing to a trust. In India, a mutual fund is not legally a company. It's set up as a trust under the Indian Trusts Act of 1882.
Okay, a trust. That word feels a bit vintage, doesn't it? An act from 1882 running our high-speed modern finance. Why that?
It all comes down to the most fundamental question. Who owns the money? In a normal company, your investment becomes their asset. You can do what they want with it.
Right.
In a trust, the money, the trust property, never belongs to the people managing it. It legally belongs to the beneficiaries.
And the beneficiaries are us, the investors.
Correct. The managers control the decisions, but they never, not for a second, actually own the capital. It separates ownership from control.
Okay, so that's wall number one of the fortress. Legal ownership stays with me. But, a trust doesn't just appear out of thin air. Someone has to start it.
And in the mutual fund world, that entity is called the sponsor. They're the promoter. They have the idea. They go to the regulator, SEBI, and say, we want to start a fund.
Okay, now in the tech world, anyone with a laptop can be a founder. I'm guessing the bar is a little higher here.
Significantly higher. SEBI has a very strict checklist. First, you need a sound track record. You have to have been in financial services for at least 5 years.
So no genius stock picker who just made a killing in crypto last year can just start a fund?
No. You need 5 years of institutional history, and you need to be profitable. The rule says a positive net worth for the last 5 years and net profit in 3 of those 5.
That's interesting. It forces stability. They don't want a sponsor who is, desperate for cash.
Exactly. And there's one more big rule, the skin in the game rule. The sponsor has to contribute at least 40% to the net worth of the asset management company.
We'll get to the asset management company, the AMC, in a bit. But basically, the sponsor has to put up their own cash first.
Precisely. They are financially committed from day one.
Okay, but this is where I get a little skeptical. The sponsor sets it all up. They put in the money. What's to stop them from treating this trust like their own personal piggy bank?
And that's the danger, right?
Yeah.
Which is why the law creates the second tier of the architecture, the trustees. If the sponsor is the creator, the trustees are the guardians.
Guardian sounds nice, but aren't they just appointed by the sponsor? What's to stop me from appointing my best friends as trustees?
That's the perfect question, and SEBI thought of that. The rules on who can be a trustee are incredibly tight. First, you need at least 4 of them, but here's the golden rule. At least 2/3 of the trustees must be independent.
Define independent.
It means they can't be associated with the sponsor. Not an employee, not a relative, no major business connection. Their legal duty is not to the sponsor who appointed them, it is to the unit holders, to you.
So they're like an independent board whose main job is to say no.
In a way, yes, and they have the nuclear option. If they think the AMC is acting against investor interests, the trustees have the power to actually dismiss the asset management company.
Wow. They can fire the entire firm.
They can. It's rare, but the power is there. It completely shifts the leverage.
Okay, so we've got the sponsor with the idea and the trustees with the oversight, but neither of them are actually, picking stocks day to day. Who does the work?
That brings us to Tier 3. The asset management company, or AMC, this is the brand you actually know, HDFC Mutual Fund, SBI Mutual Fund, and so on. They're appointed by the trustees to run the show.
The doers.
the doers. And even here, the structure is regulated.
I'm guessing more independent directors.
Yep. At least 50% of the AMC's board must be independent. So you have independent oversight at the trust level and at the company level. Plus, there's a huge financial barrier. As of early 2024, an AMC needs a net worth of at least 50 crore rupees.
50 crore, that's not pocket change.
It ensures the AMC is a serious, stable entity that can absorb shocks.
Okay, this is making sense. Sponsor, trustee, AMC. But I want to go back to the money itself. My 5,000 rupee SIP goes in. The AMC decides to buy some Reliance shares. Does the AMC's bank account hold my money, even for a night?
And this is probably the single most important safety feature for any investor to understand. The answer is an emphatic no.
Never.
The AMC never touches your money. Not for a second. This is where another key player comes in, the custodian. Think of them as the vault.
Okay, walk me through it.
You send your money, it goes to a bank account controlled by the trustees, managed by the custodian, not the AMC. The fund manager says, buy Reliance. The instruction goes out, but the actual settlement money going out, shares coming in, handled by the custodian. The shares then sit in the custodian's digital vault.
So the fund manager can't just write a check to a shell company in the Cayman Islands. They literally don't have the checkbook.
They do not have the checkbook. The custodian acts as that check and balance. And before you ask,
What if the sponsor owns the custodian?
you read my mind. SEBI has a rule for that too. If a sponsor has a controlling stake in a custodian, that custodian generally can't serve that sponsor's mutual fund. The system is just obsessed with preventing conflicts of interest.
It really feels like the whole thing was designed by someone who assumes everyone is trying to cheat, so they made it physically impossible.
That's how you build a robust financial system. Trust, but verify, and then verify the verifier.
Let's look inside the AMC for a moment. We just think of the fund manager. But it's not a one-person show, is it?
Oh, far from it. And there's a specific role in there that most investors don't know about, but that saves them money every single day.
Which one is that?
The dealer.
The dealer. Sounds a bit shady.
Yeah, it's a real job title. So you have the analyst who researches a stock. Then the fund manager decides, yes, let's buy this. But the fund manager then hands that order to the dealing room.
Why? I just click buy on my app. Why does a professional need a middleman?
Because you're buying maybe 10 shares. The fund manager is buying 10 lakh shares. If they just dump an order that size on the market.
The price would spike instantly. You'd be chasing it up.
Exactly, you get slippage. The dealer's entire job is smart execution. They slice the order, use algorithms, find liquidity. They fight for every fraction of a rupee to save the investor's money.
So the fund manager is the strategist, the dealer is the sniper.
That is a perfect analogy. And it also prevents front-running. By separating the decision from the execution, you add another layer of surveillance.
This theme just keeps coming up. Separation, ownership from control, decisions from execution, custody from management.
And we can add one more, separation of risk management.
Wait, isn't managing risk the fund manager's primary job?
Their job is to generate returns, which involves taking risks. SEBI now mandates a dedicated risk officer who is independent of the investment team. Their job is to be the official pessimist.
The Department of No.
Or maybe the Department of, are you sure you've thought this through? They model worst-case scenarios and report directly to the board, ensuring the hunt for returns doesn't kill the fund.
Okay, there's one more piece I want to get to. The NAV. The price of a unit. If a fund owns stocks, that's easy to price. But what about bonds that don't trade for weeks? Can't the AMC just, guess a bit high to make their performance look better?
That used to be a real problem, but not anymore. This is where the valuation agencies come in.
Who are there?
Third-party agencies appointed by the industry body AMFI. Think CRISIL or ICRA. They provide a daily valuation matrix that tells the AMC exactly what every bond is worth on that day, based on market data.
So the AMC doesn't get to mark its own homework?
Not at all. They have to use the independent valuation. No fudging the numbers.
You mentioned AMFI there. I see their ads all the time. Mutual funds, Saki High. I think a lot of people think AMFI is the regulator.
It's a very common misconception.
Yeah.
SEBI is the regulator, the sheriff with the power to make laws and enforce them. AMFI is the industry association. It's more like the guild.
So what's their role in the fortress? Just PR?
They do that, but they also register all the distributors. They issue the ARN number you need to sell funds, and they enforce a code of conduct. They can't send you to jail, but they can kick you out of the industry, which is a Pretty powerful deterrent.
Okay, got it. SEBI makes the rules. AMFI helps everyone play nice.
That's a good way to put it.
We have covered so much ground here. Sponsors, trustees, AMCs, custodians, dealers. It really is a web, but I want to circle back to something from the start.
Go on.
The barriers to entry. 50 crore net worth, 5-year track record. This is expensive. This is complicated.
It's an incredibly high-cost structure to set up and maintain.
So here's the final thought then. Does this structure actually kill innovation? By making the fortress so hard to build, are we just creating an oligopoly where only the huge banks can ever launch a mutual fund?
That is the central tension of financial regulation, isn't it? You're right. A couple of smart people in a garage can't start a mutual fund in India. We probably miss out on some of that disruptive energy.
Yeah, you see all these niche boutique funds in the US? It feels slower here.
It is slower. But let's flip the argument. In the last decade, the Indian mutual fund industry grew from about 11 lakh crore to over 66 lakh crore. That is just explosive growth. Why?
Because people trusted it enough to raise their money from, say, real estate and gold.
And why did they trust it? Because in a market where financial literacy is still growing, one big scam, just one, could set the industry back 20 years.
That's a very fair point. If one small, innovative player ran off with a few hundred crores, a whole generation of investors might never come back.
Exactly. The high barrier to entry is the feature, not a bug. It signals to a saver that any entity calling itself a mutual fund has been through an incredible gauntlet of checks. We sacrifice some speed to guarantee systemic trust, and the growth numbers suggest that's a trade the market is happy to make.
So it's the difference between Silicon Valley's move fast and break things and the savings world's move carefully and protect the nest egg.
And when it's your retirement money, I think most people prefer the second one.
I know I do. This has been a real eye-opener. I'm not going to look at that invest button the same way again. It's not just a click. It's activating this whole web of protection.
It's a remarkable machine.
Yeah.
And it works best when you actually understand the moving parts.
Absolutely. So next time you get a fund document, maybe scroll down to the fine print. See who the trustees are, who the custodian is, and know that those names are the real reason you can sleep at night.
Thanks, Ray.
Thanks for diving in with us.
My pleasure.
We'll see you on the next